started here. So we'd like to thank you for joining us today for the first session of the Entrepreneurial Educational Series, Fundraising Bootcamp, where we'll explore how to find your funders and prepare your pitch. I'm Joseph Angotti. I'm a principal at Grouse Capital and a member of the PVCA's Emerging Leaders Board. Grouse Capital is a single family office that focuses on middle to lower market acquisitions and early stage investing. And my main role there is really to lead our early stage investing efforts. My co-MC today is Ed Engler. Ed, would you like to introduce yourself?
Sure. Good afternoon, everybody, or good morning, I should say. I'm Ed Engler, member of the PVCA board and senior coach at Aspire 360. So pleased to have everybody here today. And we have a very exciting panel to share with you.
Okay, great. Thanks, Ed. So just to give a little bit of background of the event, this is a first-time event that was created in conjunction with the Three Rivers Venture Fair, our flagship event that takes place every 12 to 18 months. This event offers the opportunity for entrepreneurs to pitch their ideas and hopefully convince investors to supply them with much-needed capital to pursue their endeavors. Over the next 2 days, we are hoping to better prepare the entrepreneurs to put their best foot forward and for these presentations to supply them with very valuable knowledge about the entrepreneurial process. Last but not least, before we get started, I would like to thank our symposium sponsors. Special events and programs like these are only possible because of them. In addition to the sponsorship of the series, our sponsors have committed to supporting the 2021 virtual Three Rivers Venture Fair. If you're interested in becoming a sponsor, please contact Micah Whitfield, the PVCA's Director of Business Development, and please let her know. Now moving on to today's event. So today we're going to talk about different ways entrepreneurs can find capital and get capital. And really we broke these up into a few different funding categories, from getting started to growth to non-dilutive. We're going to hear from an amazing panel today. We're very excited about the panel we've been able to put together. And we're going to hear a live pitch from a real entrepreneur. And then at the end, Ed and I will kind of wrap it up and talk about what we learned about the whole thing. So, 9 ways to get capital. We've really broken these up into 3 different buckets. The top 3 are really for, when you're getting started with a startup, really 2 people and an idea. The middle 3 are really towards growth. And it's really when a company starts to get indication from the market and kind of some market traction. And then the last 3 is really leveraging your customer to reduce dilution. So starting with the first category, getting started, everybody starts out, bootstrapping. Whether if you're working a day job and working on your startup in the evenings, or if you leverage your spouse's income, or even, some entrepreneurs even leverage a mortgage to get started. But that's typically where everybody gets started. Then another avenue when you're getting started is accelerators and incubators, right? There's about 1,500 in the nation. And typically they take anywhere from 0 to 20% equity for around $0 to $100,000 of investment. And all these incubators and accelerators have a different network and mentoring system that really adds value and helps accelerate the entrepreneur's business. I think going to the last avenue in this category is really crowdfunding. It's a great new avenue to obtain funding from small investors. And there's various options, from debt to equity to pure donations and prepaid revenue. Moving to our second category here, really focusing on growth capital, it seems fitting to start with the lowest cost of capital, which is banks. They are typically the lowest cost of capital for entrepreneurs and businesses, but they really are the most risk adverse. It's really tough to qualify when you have a startup starting out, just because banks typically require some type of collateral like assets, or they want some historical financial statements to show revenue and cash flow coming in. So it's typically tough when you're starting out your startup to get a loan or capital funding from a bank. And then the next one for growth would be angels. And there's really 2 big buckets here. The first bucket are angel investors who know you and trust you and really just believe in you. And the other bucket here is angel investors who have been through the problems you have solving for your customers and have been there firsthand and really understand the solution you're providing. And then the last avenue for growth capital is really venture capital. Typically, I think about 2% of startups only actually obtain venture capital investing. And it's mostly because they're interested in fast-growing companies in big markets. Typically, venture capitalists only invest in a company after some referrals from other investors. And they're really looking for experienced teams, accelerating revenue, and proven business models. Now, then the last category that founders can fund from are really no equity financing. First and foremost, customers. Really, without customers, your business is really just a pipe dream, right? As you develop your business, one customer is a random chance, 2 customers is really a coincidence, but when you get to 3 customers, you're starting to have a market. And just for reference, the custom software industry was a $388 billion industry in 2020. And that's all for products that didn't exist when they signed the contract. So you can really leverage your customers for a lot of your funding there. And another avenue is revenue-based investing. It's really a new form of financing, and I'm really excited and pleased to say we have one of the leading examples of the revenue sharing investors with Melissa at RevUp on our panelists today. And we're pretty interested to hear what she has to say. And the revenue-based investing is really a unique aligned incentives for entrepreneurs and investors because they're both incentivized to increase revenue. And lastly on this list is nonprofits and governments. There really is free money out there, but it's really hard to come by. The lead time typically takes for 6 to 22 months. And as an entrepreneur, you really need to focus on nonprofits that have a high alignment with your purpose and values. With that, I'm going to pass it off to Ed to discuss key priorities for funders.
That's great. Thanks, Joe. Well, one thing to remember across all these investors is people invest emotionally, even bankers, if you could believe it. And if you could find people who want what you want, that's going to pull them towards you and start to build your social proof. And one of the things that gets investors really excited is when the things you say start coming true. And when they want to see the change in the world that you're bringing, they start to get really compelled. But next slide, Joe. Before they get interested, though, they're going to be really afraid because all the startups lose all the money, right? So there's over a 90% chance of loss. They're just afraid. And only after they start to see progress, usually in the form of revenue or some proof of traction, as they say, they start to think that could possibly be that you would succeed. And then the momentum that you can gain over time as you grow to needing less and less money and growing faster and faster, being more attractive to other investors, they'll get the fear of missing out. And that's when they'll want to jump on your train. Next slide, Joe. So one of the things that's key is for each one of these kinds of investors to pick your timing, right? They all have different things they're interested in. You're going to be looking at a series of investors probably to fund your initiative, and you're probably going to do it in parallel with customers. These things go together, and we'll see that, I think, in today's example. So make progress and pick your timing. With that, I'd like to introduce Ilana Diamond, our moderator today, and she's had too long of an esteemed history for me to speak of here, and I'll let her talk about herself and introduce the panel. Ilana?
Thank you, Ed. Well, I don't know if I guess saying I've got a long history is the same thing as I'm saying old, right, Ed?
I didn't say that.
No, you didn't. I'm just joking. I'm the managing partner of 412 Venture Fund, and in that role, I lead fund activities, including sourcing, evaluating companies, and investing in some of our region's hottest companies and startups. And previous to that role, I was a managing director at Innovation Works, where I led and co-founded Alpha Lab Gear, a leading accelerator for physical product companies, and also led our hardware team and was a managing director at Riverfront Venture, one of the most active seed stage investors in the country. And I'm really excited to be here. I'd like to introduce our panelists and our founder who's going to be pitching today. First, let me give you a little bit of background about what we're going to be doing, and then I'll introduce the panel. First, we're going to have a founder do a pitch, and then we're going to have the rest of our esteemed panelists who are all investors at different stages, and as Ed pointed out, with different goals. We're going to have them ask questions just as they would if our founder was pitching to them. And then we're going to encourage you, the audience, to ask questions. You can put them into the chat. And so if you hear a question and you're wondering why the investor asked that question or why the investor didn't ask a different question, feel free to just put that in the chat and we're going to have a conversation. So it'll be the founder pitching, the investors asking questions, and you, the audience, asking us about why we asked those questions, how we felt about the answers, or if you have comments, we'd like to hear those too. So I hope we're going to get some good conversation going here. And now to introducing my other panelists. First of all, we have Rachel Reid, who is the founder and CEO of Subtl Beauty, a company that's simplifying the daily beauty routine for busy women on the go. And Rachel's going to be our pitcher today. Then we have Zach Malone, who's a partner at Draper Triangle Ventures. He currently serves as a board member on behalf of the firm at Day Owl, Locomation, and ICOS, all local companies. And prior to joining Draper, he worked as an analyst at UPMC Enterprises and Gateway Financial. He currently serves on the board of PVCA, the Pittsburgh Venture Capital Association, ELB, the Mattress Factory Board of Directors, the City of Pittsburgh Startup Advisory Board, and the Capital Foundry. Zach received his BS in Finance at Virginia Tech. Next, we have Jenn Van Dam, who serves as Digital and Community Engagement Manager at IW. In that role, Jenn manages the online presence for IW's programs and develops messaging and branding for the organization, engages with diverse tech and investor communities through outreach, relationship building, and she works with IW and Riverfront portfolio companies to develop their marketing strategies. She's also co-host of IW's podcast, Caffeinated Innovation. And if you haven't caught that yet, you definitely should, because lots of good guests and lots of interesting information there as well. Jenn is committed to supporting and empowering people of color, LGBTQIA folks, women, and underserved communities. And she does that not only through her role at IW, but she also serves on a wide range of boards and committees in Pittsburgh, PVCA, the Allegheny Conference on Community Development, Athena Pittsburgh, Invest in Her, and she's involved with the Grace Hopper Celebration and HBCU-VC as a scholarship reviewer. And finally, we have Melissa Withers from RevUp Capital. She's a managing partner there. She's an experienced fund manager and business builder with 120 plus investments under management. Melissa co-founded RevUp in 2016 after working as an early stage equity investor for many years, and she was driven by the opportunity to change that exit or bust constraint of equity-only investing. Today, RevUp has investments across the US in a spectrum of B2B and B2C companies. Melissa began her career working at the intersection of science, education, and public policy at the Whitehead Institute for Biomedical Research at MIT. She was also the co-founder of the Business Innovation Factory, an organization dedicated to the design and testing of new business models in areas of high social significance. In addition to her role at RevUp, Melissa is an entrepreneur in residence at Techstars Boston, a strong advocate for expanding investments in women and people of color and those living outside traditional top-tier markets. She also runs Operation Athena, a program that offers investment and support to women-led companies and those founded by people of color. And if not for her family, love of gin, and preference for indoor plumbing, she'd likely spend her days hiking. I'm with you there, Melissa. So now on to the meat of the program with the pitch by Rachel Reid from Subtl Beauty. Rachel, do you want to turn on your?
Sure. Let me get queued up here. All right. And then just let me know if you can see my screen.
I can.
Yes, we can.
Okay. Awesome. All right. Thank you, everybody. My name is Rachel Reid, and here at Subtl Beauty, we are simplifying the daily beauty routine for women on the go. You see, the average woman has 16 different products in her morning routine alone. Products that are all different shapes and sizes, stuffed into a bag that she can barely zip up. Now, these diverse packaging concepts are great on display, but they are cumbersome and they lack practicality, especially when you look at the busy lifestyles of modern women today. So instead of looking at individual products, we approach our innovation with consideration to the entire beauty routine and the lifestyles of these women. Meet the Subtl Beauty Stack. we took the products that women are reaching for each and every day, and we put those products in a compact, portable kit that allows women the freedom and flexibility to do their routine wherever they find themselves, whether it be in the car on the way to their destination, at the gym after a morning workout, or even the 2 minutes she has at her desk before jumping into a Zoom meeting. The Subtl stack offers a level of convenience that can be tough to find in the beauty industry. Each stack is completely customizable to meet each person's specific routine needs. And with 3.5 grams of formula in each layer, the Subtl Beauty products last 6 weeks longer than travel size alternatives, all while being small enough to fit in the palm of your hand. Now, not only is our packaging designed with real utility in mind, but each of our multitasking formulas have been designed for on-the-go application. Now, in the 2 years since launch, we've grown 32% month over month. Last year, we shipped over 20,000 stacks to all 50 states. We're featured in BuzzFeed, Allure Magazine, Business Insider, and we also just secured a second purchase order from Urban Outfitters after completely selling out of 3 of our SKUs on their website within 3 weeks. In year 2, we generated over $1 million in revenue, a 4x growth compared to 2019. And we are now on track to generate $3.7 million in revenue this year. Now, the beauty of beauty is our great unit economics. So with a customer acquisition cost of $24 and a margin of 86%, we are actually profitable on first purchase. Now, this is the team that is making it all happen. You see, my first job was actually in the beauty industry, labeling products for my mom's skincare company in my home country of New Zealand. I then spent my professional career in an early stage, high growth startup managing multi-million-dollar e-commerce clients. My full team here has a rich experience in the beauty industry across supply chain, product, and marketing. And of course, not pictured is our small army of freelancers bringing this all to life. Now, this is just the beginning. With the help of a former Estee Lauder VP, we are building a sustainable, refillable packaging platform that allows Subtl Beauty to not only expand our makeup offerings, but expand into other categories like skincare, body care, hair care, all in a single packaging solution, something that no other brand is doing today. And you better believe we've filed a patent on that. Now, we are raising a $1.2 million seed round to accomplish 3 things: enable omni-channel distribution, increase customer retention, and then of course, facilitate the scale to support the above. The beauty industry is set to grow from $530 billion to $800 billion by the year 2024. So now more than ever is the time to invest in this space. We are Subtl Beauty. This is a Subtl Beauty stack, and I'd like to open up the floor for questions.
Thank you, Rachel.
Yeah.
That was great. So I'd like to open it up to our investor panel. Somebody want to go first? You can take yourself off mute and maybe turn on your cameras too. There we go. Jenn, maybe.
Hi, Rachel.
Okay, go ahead. Sorry.
No, that's okay. I wasn't sure what the protocol was. Thank you for the presentation. I have a question for you around the general timing for Subtl in the market. You know, if you look back at what drives outcomes for early stage companies, timing is often the thing that is the factor underlying that, but it's the thing we have the least control over. What do you think is happening right now in the market that makes this the time for Subtl Beauty and the time for you to invest into the forward growth of the company?
Sure. Well, I mean, like most great founders, you know, I started Subtl to solve a problem in my own life, a convenience problem that other brands just weren't addressing. You know, I was living out of a suitcase. I never had time to do my makeup in the morning. And honestly, I wanted the freedom to apply my makeup from wherever I found myself. And for many of us, you know, makeup is confidence, and a busy woman shouldn't have to sacrifice confidence for the other things that she's doing in her day. You know, with the right solution, I believe there's room for both. And other brands are kind of slow to, you know, taking on this role of solving problems like this. They're so caught up in, you know, almost like the fast fashion, but in makeup. churning out these giant 40 shade palettes and really hitting an audience that you would typically find, in front of in a YouTube video. There's a huge segment of women whose needs are going unmet. And so I believe that it needed to come from outside of the industry, the solution. I think that to be able to look at it in a different lens and, to really kind of speak to that audience. And I think that is what our unique advantage is. And I think why our timing is so great is because we're living in an age where, women don't have time to spend all, 40 minutes in the morning each day. And so that, I believe that is why, the timing is perfect on this one.
Thanks.
Rachel, so I think with my accelerator hat on, I'm going to be repeating all of Melissa's questions, but asking you how you talked about this when you were at that really, really early stage. So when you think about how you figured out that those were the needs of your customers and understood your audience, can you talk a little bit about how you understood your audience and how you came to understand that those were their needs?
Sure. So I, first and foremost, I kind of am my own customer, at least I was in the beginning. And so I kind of took that initial sort of seed and did a couple of things. I did some preliminary market research, at the stage that you're at when you're starting out with an idea, it is very hard to know where to look, where to source that information. I then, started getting more active in the startup community in Pittsburgh, which opened, myself up and the company up to different ways of finding this information. So I actually did some pretty extensive customer discovery, really pulling everyone in my network, and not just people that I knew that I was interviewing, but hey, can you introduce me to people in your network that I've never met before, and having these conversations, not telling them what I'm doing, but asking a series of questions around how they're, if there even is a problem. And if so, how are they solving it today? Do they feel like they have the solution is working for them? Where are the gaps? And I probably interviewed over 30 to 40 women, either over Zoom or in person, and then kind of supported those interview questions with more of a survey base where I just sort of send it to everyone and anyone. So, if you're on this call and you receive that survey, thank you. Just to really gather that data as much as possible to either prove my hypothesis or form a new one.
And so I guess before, Zach, you ask a question, I'm kind of curious, since Melissa and Jen sort of talked about different stages and different type of investor around the timing issue. As an equity investor, what are you looking for in an answer with regard to timing? What are you looking for in a company with regard to proof that it's the right time for that? And what are you looking for in the answer, if you could maybe speak to that? Zach?
Oh. Sorry there. As far as, I don't know if I'd be looking for anything specific other than hearing Rachel's opinion, to be honest. I think, the best thing we can do in these early discussions is really understand her state of mind and what she's looking for. And, I don't think that I would ask it in the sense that I'd be looking for a specific response, if that makes sense.
Okay. So I sort of waylaid your question with my question. So go ahead. Did you have a question for Rachel?
Sure. Yeah, Rachel. It's somewhat in the same vein as what we just discussed, but following the close of this $1.2 million round, what do you foresee as kind of your biggest challenges, and what do you think will keep you up at night? And what's your plan to overcome them? I realize this is an open-ended, question, so maybe just a top one or two.
Sure. So I think we have our team in place. I think we have a really solid strategic team. Very fortunate to have that. I'd say the piece that's going to keep me up at night is getting to that next level in terms of our omni-channel approach, which is securing our retail placement. So everything that we're doing this year is positioning ourselves for a really big retail partnership next year. We are digitally native, but I believe that to take a company from $100 million to $500 million in terms of valuation, we really need to be diversifying our sales channels. So we're, having conversations, having those conversations in the next month with the likes of Ulta and Sephora, and making that happen and bringing that to life without having gone down that path yet. As a founder of a beauty company, that's something that keeps me up at night for sure. But in saying that, I also have a team who's all done it before. I'm the only one who actually hasn't done it. So, very fortunate to have surrounded myself with, the right people.
Ilana, can we ask follow on multiple questions, or
Absolutely.
does everyone need to go? So, Rachel, one of the exciting things about being in e-commerce at this moment is a lot of the barriers to entry have really lowered, right? You can get an e-commerce platform set up pretty quick, putting development, hardware, inventory costs in its own painful, horrifying bucket. But as a consequence, I think there's been a shift over the last few years about the speed at which you have to move from being a product to an experience because of how quickly people can be distracted by other shiny, fun things to buy online. And thinking about the experience, it's why so many e-commerce direct-to-consumer companies kind of fart out between like $1 million and $3 million in sales. Tell me a little bit about your secret sauce, your vision for how you're going to cross this chasm.
To get from 1 million to 4?
To really make that trapeze leap from being just a product to more of an experience, right? Where you're actually creating a little bit more of a stickiness with your customers and getting out of the product itself.
Sure. Yeah. So, what you see here today, like what I have in my hand, what we sold 20,000 units of last year, is very much an MVP. We're talking about money here. It was what I had in my savings account and what my savings account could afford. So we actually spent the first 2 years with this MVP working with contract manufacturers with their kind of off the shelf formula that anyone can access to prove that there was a need for a concept like this. And so when you talk about, okay, what's going to get us to that next level? What's going to differentiate us from product to brand? We are now starting to do that grunt work now that we have established, okay, that a product like this can exist. And so that's why I made the strategic hire of bringing a director of product on to take a look at our formulas first and foremost and do a competitive analysis and get them not only to where market is, but to exceed market, so that when a customer buys a stack for the first time, let's be honest, it's probably because this is really convenient compared to what she has. But we want her to stay and to, have that brand affinity because the formulas are so great. So we're making improvements on the formula side to improve her experience. We're also doing a lot of brand work this year. I think we've collected enough data to be able to really get a sense of, who our customer is, what drives her, what are her emotional triggers, to really speak to her and make sure that our brand language speaks to our core customer and really niche down there. And then the other piece is, packaging, the feel and the experience of the packaging. We want it to feel luxurious. We want it to feel make her feel proud to whip it out at a restaurant and to touch up her lip or her concealer. And so it's sort of a trifecta of all the things that we're working on at this very moment in order to position ourselves and to take us from pure product up into that level of true brand.
So, sorry, can I ask another question?
Sure.
Yeah.
Go ahead, just jump in. I've got some questions from the audience too, but I'm waiting for you guys to get your main questions out first.
Cool. Rachel, you've had a lot of great traction, over the years since you started. What would you say is kind of the top, lesson you've learned, or something maybe you wish you had done differently, but you discovered now you're going to change moving forward?
That's tough because I think a lot of the decisions I made were based on the resources I had in the moment. So I think that, if I was not resource constrained, I probably would have waited a little bit longer to launch product, done a little bit more like grunt work on the brand front up, on the brand side earlier on. But the fact is that, we, for the most part, bootstrapped at least to market. And so, looking back, maybe a blessing, but we then were able to collect our own data instead of relying on other people's data to form those opinions. I would say that we've sort of been very lucky with the path that we've taken and the pace that we have, have been keeping. Is it cliche to say I wouldn't have done anything differently? I think I'm very grateful to kind of where we've gotten so far.
Cool, thank you. No, and it's not cliche by any means.
Rachel, on that question, so, and don't go too far into this because you're on a panel for IW tomorrow on crowdfunding, but, something, just thinking about something, an investor, you didn't talk about your crowdfunding campaign that you did in the past in your deck, but as an investor, right, I would have researched your company and known all of these things before. So can you talk a little bit about crowdfunding, why you chose it, and then like what you learned, because I'm sure you got a ton of information about your customer from crowdfunding.
Yeah, actually, just before we jumped on this panel, I did a quick list of all of my different all the different funding that I've done. So like savings, crowdfunding, government, accelerator, equity, rev share, we've kind of done it all. On the crowdfunding piece, that was probably my first experience into, I guess, sourcing capital from other people. And I did a ton of research on how to run a successful campaign. One of the really interesting things that I think a lot of founders don't realize when it comes to crowdfunding is that it's in and of itself a whole strategy. So, what you list as your target is not what you're actually hoping to raise. It's what you're hoping to be able to raise within the first 2 to 3 days, trying not to get down a rabbit hole so I can save it for tomorrow. But there's all these little nuances. And I think that sometimes, and perhaps myself too, you sort of make the incorrect assumption that the crowdfunding campaign is going to solve all your problems, but it's costly. It requires a unique strategy in and of itself. And so I think that people really need to just jump into the weeds on all things crowdfunding before they sort of like write it, on their list as like a problem solve for them. I'd say outside of learning the nuances of crowdfunding as being one of my biggest lessons, I think that what it did afford was a crash course in marketing and product launch. And on a personal front, it was sort of the first time that I was announcing to my network that I had been working on this. I'd been working on this for maybe a year and a half, 2 years, and it was very frightening. And so I think from a founder perspective, you're forced to just be out there and be everywhere. And I know that we're not all comfortable in that role, but it's one of those things that you just have to do in order to move the needle. And I think the Kickstarter was a really great vacuumed opportunity to kind of foreshadow what was required of me as a founder in the years to come.
Thanks.
Well, I have a couple of questions from the audience that I'll ask, and then we can sort of rotate in with the panel. Don Williams asked, how would you rank, this is to the panelists actually, how would you rank and weight a venture's identified problem, solution, market opportunity, and projections? When you're thinking about which of the aspects are the most important, maybe each of you could, Melissa, Jen, and Zach, from your perspective, say, how would you rank them? So it's the problem.
I would say of the items listed, I mean, I really think of it more as a virtuous cycle. I think the idea that you can rank those things, it really depends on the company in terms of where the critical risks and opportunities are. I think I mostly would see how do those pieces all fit together? Where are the vulnerabilities? And does the founding team have a transparent awareness and acceptance of those realities, right? All early stage companies have flaws across those things. And do they understand how those things stitch together? I think certainly when you get to the topic of team, there is no company if the team doesn't have just core gravitas, right? They either, because they bring something special to the party, or more important, they know how to attract talent to the company on an ongoing basis, and that there's evidence that they can do that. It's a real red flag sometimes when a company hasn't had anyone really substantively from the outside come and participate, when it's really just been a small group, because you wonder if they'll have that ability to attract talent. So I think rather than rank them, and I would put projections at the bottom, in the same token, where team would go at the top. I mean, projections are an exercise in speculative fun. I think they're telling about how the founders think about the company's trajectory. But once you get past sort of the short-term financial realities, the projections become more of a visioning exercise. Like, where could this go? Particularly if they're in an early stage company that's maybe pre-market. So I would say think of them more as a virtuous cycle and as a connected unit, where there's certainly what you want to be able to check for is, can the strength of one compensate for the weakness of the other while the team is coming up the curve and trying to make that engine whole?
That makes a lot of sense. Jenn or Zach, do either of you want to add anything to that?
I don't know if I can add anything intelligent to that response. I think that was a perfect summary, because I think you're spot on, Melissa. And, at the end of the day, this is, not the actual way that we proceed in these discussions, right? This would be hundreds of hours of back and forth to really make a decision. So I do think, Melissa's summary on how there's no real ranking, but it's really viewing the whole in each piece and how it fits in is the most important way to proceed.
And Jenn, you see companies at a much earlier stage. And so
Right.
A lot of these things aren't worked out. So how are you thinking about this?
Yeah, I mean, the team is definitely at the top, right? So does the team get the problem? Is this a real problem? And are they the right team to solve it? And because this is what we're thinking through is this is an accelerator program, we're going to be working so closely with those founders. Are they coachable, right? Like, do they need the information and the support that we can provide in our program? So team, for sure.
And I'm just going to ask one more question from the audience, because we've got a lot of them, and I'd like to get through a couple before we go back to the panel. I think this is something people would really like to know, Rachel. This is from Keith Kachiba, who it's kind of a founder question. During the seeking and funding process, what % of your time, Rachel, was spent on keeping everything organized and keeping the lights on versus doing the work of actually moving the business closer to the goal?
I'm assuming is the closer to the goal of fundraising. Man, that's a hard question, because honestly, it depends on the day. I go back and forth. I would consider myself a fairly quote unquote risk averse founder. And so even before I took the leap to pursue this as a company, I made sure that we could achieve profitability on our own. Even if it was slow. If it was slow, that's fine, but we could do it. And so last year when I was raising like my smaller round, I made sure that the majority of my time was actually spent positioning the company to kind of run on its own, so that I wouldn't have to be in the weeds day in, day out in order to ensure that the lights are on. And then just making sure that you're not spending beyond what you need and kind of balancing that out. So I guess I go back and forth. I kind of get back into the business if we need to make tweaks, or if we may need to kind of optimize the financial sheet. If you get an accountant, that's fine, but I highly recommend tracking it on your own as well, to make sure you know every single dollar going out and coming in. It's also just a comfort level thing when you know how much money you're kind of burning each month. So, when things need to be optimized, I jump back in over there. When I feel like we're good and we're humming along, then I kind of jump back into fundraising. But it's tough. I will go, a week or two without having an investor meeting, and then some weeks it's just fully stacked with 8 to 10 meetings. You kind of have to make that call for yourself based on where you are needed at the time.
And actually, Keith had an investor side to this question too. Around, do any of you, Melissa, Jenn, Zach, are there any red flags, that you would be looking for in how a founder balances these things?
I have an incredible amount of empathy for the burden of fundraising. And even for the people in the audience, I think rather than even use the word fundraising, you should just start using the word capitalize, because it's not just fundraising, it's how are you going to capitalize your business. Rachel has needs for her business as others do that are going to stretch forever. And I think we use the word fundraising as though capitalizing your business is this thing that you do at these interstitial steps, but it's like a treadmill. You're going to need resources for different purposes. And we tend to focus on the equity rounds or the fundraising rounds, even if they're not equity investors. But really having a dynamic capital strategy for your business is becoming a talent and a skill that you need to integrate into your business earlier and earlier and earlier, particularly as different kinds of dollars become available for earlier stage companies. So I think it's why being CEO sort of sucks. You get the shittiest jobs of all. You have to fundraise, you have to manage your advisory or governance boards, you have to hire and fire and do all these other things. And so oftentimes it's, as companies grow, either the CEO moves out of that role and passes that off to someone who really loves that stuff, or brings on other C-suite people to compensate for that. Because really capitalizing your business through time can be all consuming. And it often is. So I think, in terms of red flags, I think it's just more, and someone else said this earlier, I think it was Zach, it's not so much that I expect to hear a certain answer about how a founder is managing this. I know how painful it is. I've been there. It's more that there's an ability to articulate and demonstrate transparency and candor around the trade-offs and what's happening. I will say, as just a tip to the audience, one of the biggest mistakes founders make is they give investors reasons to wait by putting things into their deck about all the good things that are just about to happen, customers that are just about to close, pilots that are just about to start. And you actually can extend your fundraising process by giving me every reason to say, well, circle back in 30 days after you've closed those pilots. So when you think about owning your narrative, owning your KPIs, and tracking that against the right round that you want to raise, how long you think it's gonna take, you can be really cognizant of the things you might be doing to self-sabotage the pace of that raise, and continue to have it be a focus. I think it's really difficult to effectively raise money and also split your time elsewhere. But to Rachel's point, you do what you have to do and you figure it out and you just make the trade-offs. And as long as you are honest with yourself about those trade-offs, honest with your team and honest with your advisors and supporters, then at least we can all be we can support you. We can use that transparency and candor to support you with the right resources at the right time.
That's a great question. Did you want to say something, Zach, about this?
I thought Melissa's response was great. I was going to add, maybe re-emphasize the point about transparency. And I feel like that's a lack of transparency for the biggest red flag during these discussions, right? You never want to get the impression that a founder is just telling you what you want to hear just to try to get capital and move on. This is the beginning of a long relationship, and you want to make sure that you're developing that even early on.
So we have another question from the audience that I think is, Jenn, would be a good one for you to start with. Is it always necessary to have some ground gained and experience in the business, or is it possible to get investors in before starting the business, just from the idea structured in a deck? And how much experience is needed, and how can you get investors in then? And I know that you deal with that every day.
Yeah. So it's not always necessary to have, customers and traction and all of that, right? Especially for an accelerator program. Sometimes just, getting into an accelerator program or having the right connections to investors who are saying, hey, I'm interested in this, and having them support you within their network is the best way to, get the next investor or get that more interest. So yeah, you don't always have to have all of that.
And Zach and Melissa, I don't know, from your perspectives, is that a little different answer? Because Jenn is—
Yeah, I mean, earlier you guys have heard my diatribe about the sort of this idea that there's one size fits all approach to whether or not a company is on the right path. There are tons of companies that are pre-revenue for a very long time. If you think about technology-driven companies, all the really important stuff in our world, I mean, we wouldn't have a COVID-19 vaccine if we didn't have a whole lot of money that went into early stage pre-revenue companies. And this isn't just super deep tech companies. There's the vast majority of angel investing is done into pre-revenue companies. I think what you need to do is really be asset driven and thinking about your story and what is it that the investor is investing into, and having the ability to project the future while also projecting the foundation of the present and really giving that credibility that you are the right team. You know, always, I think when you're really early, there's like 3 things I'd like to see in a pitch. You kind of talk, well, even later, I like to see it, but just ask yourself, you know, why now? The timing aspect, what's going on in the world that makes this the moment for your venture? The why this, why is your intervention, whatever it is, product, service, whatever, why is this the right intervention to match with that moment? And why you? Why are you the person or the team that's gonna tie all that together and keep this company from going into the dustbin of history? I think Ed said earlier that you know, something about startup failure. I used to say that, you know, startups were born to die. It's what we do best. So I think what you're in the beginning, there's a ton of investors that will invest in pre-revenue, early stage companies, but you really have to nail that kind of why now, why this, why you, because otherwise, I mean, it's just a bag of bones, right? You've got to kind of give some structure to that. But lots of people invest in pre-revenue companies. I invest in pre-revenue companies, just not from this fund.
Okay.
Yeah,
Sorry, go ahead.
No, go ahead, Ilana.
No, go ahead, Zach. I was just going to move to the next question, so I'd like to hear what you're saying.
I was going to say that, you know, it's probably also important too to keep in mind that even if you're talking to an investor that may typically invest at a later stage, right, that's still an opportunity to really tell your story. And maybe it's not a fit for that round, but, you know, down the road it can be important. So
that's a really good point. So there's another question from the audience, from Michael, and this is for both Rachel and our panel, starting with Rachel. You know, what are you thinking about in terms of the exit? What's your goal? What's your strategy? And then we'd like to hear from the panel, you know, what do you look for from a founder in terms of addressing that exit?
Yeah, so the quick version is, you know, to be acquired by a larger company. There are essentially, you know, kind of 8 giant conglomerates in the beauty industry that own 85 to 90% of the market. And so our goal is to essentially be acquired by one of those big 8. These 8 companies, they have been redistributing their innovation budget over to M&A for years and years, realizing that it is more advantageous for them to allow these small indie beauty brands to do all the hard work up front, prove out the market, prove there is an audience for a certain product and brand, grow that, and then they will acquire and give that startup the resources that they may need to kind of accelerate beyond you know, the growth that they had experienced. And so, you know, that is our goal, is to be acquired by one of the 8. We have a couple of specific ones in mind in that group, and we'll, you know, start kind of like doing the work to get on their radar more so than we are right now.
You know, I think for the accelerators, right, we're so early that the exit strategy is something we're talking about with companies, but we're letting them lead that conversation. So where do you want to go? We're not expecting companies to say, I want to be acquired. We're talking to them, letting them know that there are different options out there, but not really pushing them in one direction. So
probably one of the basic attributes we would like to see is just to make sure that you're looking for, you know, a large exit one day. And this isn't a company that, you know, you maybe continue to run in perpetuity. As far as, you know, specific acquirers, I think we're pretty similar to Jenn, that there's no need to have a perfectly clear path identified. What is important is to demonstrate an understanding of the dynamics of the potential acquirers in the market and what really makes you a fit and why they would want to purchase your company.
With my current fund, I have the most flexibility here using a revenue model. We are exit agnostic. So what's important to us is that we understand the founder's view for what is the terminus here. What are they shooting for? And because it informs a lot of the decisions that you make early on, both whose money you take, how you spend it, and how you look at whether or not you want to be cash flow break even or profitable. Like there's all different, and there are no wrong answers here, just choices that the further you get, the impacts of those choices become harder to undo. It's like DNA. Capital strategy is like DNA, and it replicates fast. And it's really, the further along you get and the more more mature the organization gets, the harder it is to undo that, because it's replicated across the whole organization. So for my fund, because we're exit agnostic, we're looking more about how quickly a company can grow, from $1 million to say $10 or $15 million, and what will they need up that path. But having been an equity investor and then working with companies, even in my fund, that see themselves as being on an equity enabled exit on the path. I think the other thing to remember is there's different kinds of exit multiples that different kinds of equity funders look for. There's big V venture, which is looking for, at least on paper, everyone's looking for giant multiples. But behind the scenes, most of these funds make their bread and butter on not that. And then they have a few of those that offset it. But there's other ways that people don't think about when you're planning your strategy to get to an exit point that's gonna work for you as the founder. So many exits happen, not headlines in TechCrunch, but more about, PE roll-ups, other kinds of exits that can produce, satisfactory multiples if you haven't overcapitalized the business and gotten yourself into a real crunch. If you're in a situation where for you to retain any ownership or make any money, you have to have a 10x exit, well, then you've really set yourself up for a very narrow exit hole, right? Like a BB gun hole. However, if you think about your capital strategy and your plan along the way, and you sort of retain some control along the way as you're rolling down that snowball down the hill, then maybe a 3x multiple could be good for everybody, right? So it really depends on who those early investors are, whether they're life cycle investors and they're going to stay with you. I think the important thing to remember is you're challenged on day one to name what you want the end to be. And so, but make something up that you feel comfortable with, but know that as you go, you can refine that vision, and that as you travel down the path, your exit opportunities will open up and close in different ways. So you may have a small exit opportunity the size of a BB, or you might have, a softball sized exit opportunity, where somewhere in between there are outcomes that'll be good for you, for your team, your family, and your investors. But that's, again, goes back to, kind of beating the dead horse about capital strategy. But you can see how if you in the beginning, if you kind of miscalculate that's hard to undo. If later you sort of you think, oh, I think I'd rather have a softball size exit, but you set yourself up to be on the BB gun path, that can be difficult to undo. So I think that these are good conversations to have with your capital partners, with your advisors, as you go, and checking in, every time you're thinking about it, to see if maybe your exit opportunities look a little different today than they did yesterday.
And that actually leads right in, Melissa, to what I think is our last question, because we're almost out of time. And it's both for Rachel and for all the panelists. And it is around, fitting your vision to your investors, right? And so maybe we'll start with Rachel, if you could speak a little bit about how you think about fit in terms of when you're talking to investors, what are you looking for? What are you thinking about? Is this the right investor for me? And then the questions, there were several questions around this. If our panelists would talk about, first of all, how Rachel's business fits with your model, and then secondly, in general, how you think about fit, investor, founder fit. So Rachel, I'll let you kick that off.
It's a tough one. I think it depends on what you need at the time. So, there were times, this is not my first round. I've done pre-seed. I've done a pre-seed round. So often I will talk about my experience there. There were times where I felt like I needed perhaps a more strategic partner, and times where I just needed cash, and I think it really kind of depends on what you need. I think right now I am in a position where I kind of know what the next 2 years are like. Of the investors that I have, I feel strongly that I have some really great strategic partners who can help kind of get us to that next level. And so what I would be seeking to fill out the rest of my round is sort of, people who believe in the vision, who trust founders, who understand the industry enough. And honestly, I base it off of the kinds of questions I get. And I'm still figuring this out. I am still a fairly sort of new company, and I'm learning that the kinds of questions that an investor will ask specifically about the beauty industry or about the problem we're solving is very telling to their understanding of the industry and the problem we're solving. And I'm starting to use those questions to kind of weed out if they would be a good fit for us in terms of partnership. You kind of need someone who understands what you're doing, and you don't have to, present a 20-minute pitch on every decision you make because of their lack of knowledge. So I think that it's kind of, there's a couple of considerations that you sort of have to weigh when you're talking with investors. I hope that answered it okay.
I think that was really helpful for people to know how you're thinking about it. And then now we'd like to hear about it from the investor side. You want to lead us off, Zach?
Sure, I'll kick it off. I'll have the worst response, so I'll go first. Jenn and Melissa can clean it up. From the investor side, I guess obviously we need to believe in the company and believe in the vision and make sure there's an alignment of goals, right? And if you check that box, then there's the question of, is this a founding team that we believe we can have a good working relationship with, right? This is potentially a decade-long engagement, and we want to make sure that everyone's able to get along, because there's going to be some challenging times, right? And if you don't have those dynamics, that can cause problems. As far as getting specifics and talking about, Rachel, you mentioned strategic needs from investors, right? I guess the other thing we would ask ourselves is, if there is a specific strategic value you're looking for us to add, can we actually add it? And not just say we can, but really deliver for you. Otherwise, it's probably not going to be a good relationship moving forward.
Yeah, I think from the earliest stage of this, right, we're thinking about, specifically with my accelerator hat on, right, like we're thinking about the networks, right? Do you need the networks? Do you need our programming? And then the investment that we provide. And from the IW standpoint too, we invest in companies that are based or, have a presence in Southwestern Pennsylvania. So that does also play a part. And are those companies going to grow here and make the Southwestern Pennsylvania economy better?
I think, Rachel, you were really demure in your answer. I think, to say it maybe a little more plainly, many people will get on panels and tell you, don't take stupid money, only take money from investors that you love. But that's like a really privileged point of view that most of us don't have. It's just not how capital is distributed. And when you think about how much of it goes through networks of privilege, if you're not in that network of privilege, you may have to take money from sources that you don't love. I think what's important is understand the consequences of those choices. Try to protect, get really good advice, both before you sign and after, about what are the real world implications of that, and are there any. Always, if you can, find investors that's where we just call it smart money, where it's either going to be not burdensome to you. These are investors that are going to not really ask for more than is right to ask of you, or like as Zach mentioned, if there's a strategic contribution that you're looking for, that there's a good fit there. And certainly for me as an investor, I mean, I run a small fund. I only make 10 to 12 investments a year. Yeah, I do invest in founders that I want to spend time with because I can. But it's not because they have always had better outcomes. It's just how I like to spend my time on earth. But that is a temporary state of privilege. It's not going to be that way forever, I'm sure. But I think more important, get advice when you have to take money from investors that you think you like, but you don't know. You've got to look under the hood. And if you can get a little advice there might be ways you can buttress against outcomes from decisions that you don't even fully understand. Being thoughtful about what it means to give different rights to different kinds of investors, the difference between having advisory boards and governance boards and things like that. I think always, if you can get smart strategic money, that's going to be good life cycle money. It's going to be with you for the ride, and you enjoy, you trust those investors enough to be candid and to communicate with them. Yeah, obviously. However, none of us would have started companies. No, certainly no women, people of color, people from other geographies. We probably wouldn't start our companies if we only took money from awesome people that we knew and liked and wanted to, spend the rest of our lives with. It just wasn't how it was going to be. So more important, I think, goes back to that, tooting this horn over and over again about the burden that you have as a founder to become a capital strategist. You just got to be thinking about sitting in that chair. You're in the pole position, and just not be naive about the cost of capital. The minute you start spending someone else's money, your business will change. I guarantee you that. Then, depending on whose money you took and what their expectations are, that will further deepen the impact as time goes by. There's no right, there's no wrong, there's no good, there's no bad. There are sometimes, bad actors, and there are certainly, I've seen on the investor side some really, really shitty behavior, and I've seen founders do stupid shit that made me mental. And they deserve the blowback that they got, right? But the rest of it, usually it's somewhere in the middle of that, where it's really hard to place blame and pick a bad guy. What there are outcomes that nobody expected, situations no one wanted, and people losing money, which no one likes to do. But also founders losing dreams, founders feeling bullied, founders feeling like they don't have control over their company. These are complicated things that whenever you start spending someone else's money, to some degree, you're going to begin to experience that. But this is a place where if you can find a capital mentor, find someone who doesn't just tell you how to get the money, but can give you some advice on how to manage the people who gave you the money, and you can get through it, I think, with less black and blue marks than those of us who came before you.
I think that's a really, really good point. And, there's something, there's a point of privilege about even talking about fit, that you can talk about fit. But, I'd also say you do want to think about, are you taking money from investors who have a wide lens about what is going to make your company successful versus just pattern matching to, the kinds of people they've invested in before, particularly if you don't fit that, I don't know, Ivy League, male, white, young, whatever other patterns people are looking, we're looking for over the years. You want to know that there's a wider lens with your investor, and it's somebody who's going to be thinking about is going to be thinking openly about what makes them uncomfortable. Is it something that really is going to change how you run the business, or is it just that they haven't seen a founder like you before? So
Ilana, somebody wrote in the chat about also needy small investors. And I would say generally to almost everyone listening, if you can avoid older guys who want to write small checks and run and ruin your business, you should. That may be the one categorical group of armchair investors who write $5,000 checks and really have a lot of needs. If you can avoid that, which they never invested in me anyway, because I wasn't really their type. But yeah, so needy, annoying. If they're needy and annoying on day one, they're not going to age like a fine wine. So I would say if you have the luxury to say no, that's the one category that choose your small individual investors wisely, because that can be a real pain in the ass.
Yeah, totally true. Well, I know that we are out of time, so I'm going to turn it back to Ed and Joe.
All right. Thank you, Ilana. Wow, that was fabulous. You guys are amazing. I have to say, you're all super lucky to be invested in Rachel, for those of you who are. And for those of you who aren't, it seems like an opportune time to call her. I wanted to just highlight some things before we jump on to readiness to sell, which is such huge points, I think, especially around alignment and people. You're going to be together for a long time with your investors. So, make the ability to say no something you maintain at a high priority. And that being honest with yourself, that's probably the hardest thing. So go find a coalition of the willing, even if they won't write a check, and maybe they'll bring you to just the right investors. Now, the challenge of finding the coalition of the willing isn't that much different than finding customers, right? It's just outreach and constantly talking to people. And Melissa made a really good point that the CEO has the worst job. I'd agree with that, because not only do they have to deal with all that crap, they have to repeat themselves constantly. It's the same story over and over and over. Rachel's heard this story so many times, she can't stand it anymore. Well, good thing she's so passionate, and it's about her purpose in her heart, so she actually loves it, right? And I think that we've seen funders are all focused on revenue growth, right? So I want everybody to remember that there's these 4 factors you can study and understand without any capital at all. Who are your customers? What language do they speak? How can you connect with them? What motivations do they have? Do you know which side their bread is buttered on, or what their personal goals are, how their bonus gets paid? Good things to try to figure out. A lot of those women on the run don't get their bonus if they forgot their makeup. So it's valuable, right? And understand that value proposition. What is it that you're bringing to your customers? Just go ask them. You can find out. Once you know your customer, then you just have to start. It's interesting, the old question of in customer discovery, Oh, I've talked to 50 customers. Do I have to keep going? Is that enough? How many is enough? When can I stop? And it's interesting though, because customer discovery soon turns into marketing and you can never stop. You always need more leads. So where are you going to find them? Get used to looking for leads and getting more. And then once you find those leads, you got to get them closed, or at least interested to say, oh, I like what you're doing. I would talk to you again later. I would subscribe to your email list. I would like to get an update next quarter after you close all those pilots. Those people really count, whether they're customers or investors. Just collect them from everywhere. And if with that focus, you really don't need money to do those things. It's nicer if you have money, but you know, you can do those things the way Joe said, bootstrapping. So thanks again to the panel. Please feel free to reach out to Joe or I, and we'll share the slides. I think Ian can share the slides and the video. We'd be happy to talk to you about any of these learnings, and so you can learn more or schedule a boot camp for your group. Joe, any wrap up?
No, I think you covered it, Ed. I thought we had an amazing panel and a great presenter. So
yeah, thanks to everybody. Ian?
Thank you. Thank you, everybody, for joining. Jordan, can you please put up the next event slide? So our next event will be session 2, managing your equity capital structure and cap table, best practices and things to avoid, at 1:30. So we'll see you back here in just about an hour. Thank you, everybody, for joining.